You wake up and go to work, and every few weeks or so you get paid. And then, almost immediately, you start paying money to use that money. It's not something most people realize since you aren't getting some obvious notification on your receipt with a line that says, fee for using your money. It's much quieter than that, and it's hidden among terms such as convenience fee or surcharge. But the fee is real enough since it changes how much you are actually paying for goods and services. It's built into the price of your groceries. It's embedded in your automatic bill payments. It's in the terms and conditions nobody reads, in the court cases nobody covered, and in the laws that were passed so quietly that most people still don't know they happened. So here's the question most people don't stop to ask. When you send someone money, tap your card or click Pay Now, what actually happens? It definitely involves more than the simplified version that says your money leaves your bank and goes into the other person's bank. The more complete version, the one with extra players, the invisible clock, and the people collecting a cut from a transaction that has absolutely nothing to do with you, is surprising and not widely known. In 2024, the businesses, ranging from the chain store to the local store, paid over $220 billion in fees just to accept your money via credit cards. That wasn't interest on a loan. These were fees for the act of paying, fees for the infrastructure that sits between you and the person you're trying to pay, fees that result in higher prices for you. In fact, fees that result in higher prices for almost everybody. That $200 billion plus number is bigger than the gross domestic product of most countries on earth. And then there are the fees American consumers are paying directly. The Consumer Financial Protection Bureau reported this number is over $30 billion for 2024. And almost nobody thinks about these fees. But it's not your fault. It was designed to be quiet, so you just keep swiping and tapping. This episode is about how it all happened, because it didn't happen by accident. There were decisions made in courtrooms, in boardrooms, in the halls of Congress, and in the quiet offices of federal agencies that built the system you use every single day without choosing it. And there were people who proposed a different way, a way that would have made the whole thing free, instant, and fair. And you've never heard of them because what they proposed were quietly set aside. And right now, on the other side of the world, countries that nobody would have predicted have actually built that different way. And it works. So let's get to it and figure out why we're paying to pay. The card payment process. You're standing at a register and you tap your card. The screen in front of you says approved. You grab your bag and walk out. And that's it, right? You paid, they got paid, everything's done. Except that's not what happened. Not even close. What actually happened in that moment is that you initiated a request that traveled through a chain of companies, none of which you chose and all of which are going to take something before it gets done. Here's what actually happened when you tap that card. The first thing that occurred is called authorization. Your bank was asked in a fraction of a second whether you have the funds and whether the transaction looks legitimate. Your bank said yes, and at that moment, your available balance dropped. Well, at least from your perspective it did. Your balance has been lowered and that money can no longer be used by you, but it hadn't actually moved. Your bank simply put a hold on it. It flagged it as spoken for, while the actual movement of money was scheduled for later. That's the first thing to understand. The money didn't move when you paid. It got earmarked. Now the merchant batches up their transactions, typically at the end of the business day, and submits them all at once to their bank, called the acquiring bank. That batch goes to the card network, Visa, MasterCard, whoever's logo is on your card. The card network sorts everything out, calculates who owes what to whom across thousands of banks, and sends instructions for how to settle. This process is called clearing, and it happens overnight. Then, and only then, does the actual money begin to move between banks. That's called settlement. And depending on the transaction, that could take 1 to 3 business days after you actually made the purchase. So the moment you tapped your card to the moment the merchant actually had usable money in their account, somewhere between 1 and 3 days passed. Days during which your money was in a kind of financial no man's land. It was gone from your perspective, but not yet arrived from the merchant's perspective. It's actually sitting somewhere in between, in somebody else's hands. Well, actually a series of somebody else's hands. And here is the part that changes how you look at every transaction you've ever made. Every single entity in that chain, your bank, the card network, the merchant's bank, they made money at some point during those days for simply touching your money, however long it was. Your bank held the reserved funds from the moment of authorization. The card network managed the settlement exposure. In its 2025 financial report, Visa alone reported roughly $14 trillion in transactions for that year. This averages out to billions of dollars going through their system each day. The merchant's bank received the funds from settlement, but held them before crediting the merchant's account. At each stage, the clock was running, and in finance, time is never free. There's a name for what happens to money while it's in transit. It's called the float, and the float is not a side effect of the system. It is one of the reasons the system was built the way it was built, and the reason it has stayed the way it has. But that's the next part of the story. What matters right now is understanding that the simple act of tapping a card didn't just move money from you to a merchant. It opened a pipeline through which your money would travel slowly, by design, past several sets of hands, each of which had an interest in keeping it moving just slowly enough to make money off of it. You thought you paid instantly. The seller got paid days later, and everything in between was someone else's opportunity and profit. The float. So let's talk about time. Specifically, let's talk about what happens to money when it's technically in transit, meaning after it's left your account but before it's arrived anywhere else. Because that window, that gap between you and the business you just bought from, is one of the most valuable pieces of real estate in the entire financial system. And you're the one funding it. When you make a payment with a card, your money doesn't teleport. It moves through a process that takes days. And during those days, it passes through reserve accounts, clearing systems, and settlement infrastructure maintained by institutions that are, at any given moment, holding billions of dollars that belong to somebody else. That pool of in-transit money is called the float. And the float earns interest, but not for you, not for the merchant waiting for the payment, for the institutions holding it. And here's how it works. When your bank authorizes a transaction, say $100 for a pair of shoes, your funds are earmarked, but they don't move. They stay inside your bank's pool of reserves. And here's what the Federal Reserve itself says about what happens next. Float is money in the banking system that is counted twice for a brief time because of delays in processing. It's counted twice. The Fed calls it temporary, but temporary is doing a lot of work in that sentence. And the Fed doesn't tell you who is doing the counting. Your bank is first. That $100 is sitting in its reserve pool, often being used as part of investments earning interest. And that interest doesn't get refunded when the float window closes. It was earned during the delay, and it stayed earned. But your bank isn't the only one counting. Card networks like Visa and MasterCard don't actually move money. They move information. The actual funds flow through what are called settlement banks. These are large institutions that are designated to hold and transfer the netted aggregate of billions of dollars in transactions, while the math is being calculated across thousands of banks simultaneously. During the clearing window, these settlement banks are the temporary custodians of an enormous river of capital. This river is not flowing in a passive system. They are financial institutions, and capital that gets into their custody earns. Then there is the merchant's bank. It doesn't have the cash yet, but it has something that in institutional finance is treated almost as well, a guaranteed receivable. This is a confirmed, network-verified promise that your $100 is on its way. That receivable goes on its balance sheet as an asset. It improves the bank's liquidity ratios. It frees up capital the bank can deploy into its overnight operations. And the acquiring bank typically charges the merchant its processing fees immediately, well before releasing the funds, which is often 24 to 72 hours later. It has monetized the certainty before the cash has even arrived. I use these terms very precisely because when you go to a banker and say, well, wait a minute, you're counting that money twice, they'll say, technically not. And they'll tell you why. They'll say, well, no, we're just counting the obligation. We're counting the asset. That money can't possibly be in two places at once. While that is technically true, you have multiple hands making money off that same amount in multiple locations. So while your $100 sits in one institution's vault, the promise of your $100 is working as an asset on another institution's balance sheet at the same time. One is earning on the cash, and the other is earning on the certainty of its coming. And somewhere in between, a third institution is holding the netted sum of millions of transactions just like yours, for just long enough to matter to benefit their bottom line. The Federal Reserve calls this a temporary double counting, but the profits it generates are not temporary. They are deposited, kept, and compounded. They are a permanent transfer of value from the people whose money is in motion to the institutions managing that motion. That's the system. So let's get back to the center of all this, the card network itself. Before we dig into one credit card in particular to show as an example, we first need to define what a settlement exposure is. That is the amount of money that has been authorized but not yet fully settled across this network. Visa, in its own financial reports, disclosed that its average daily settlement exposure averages out to billions of dollars a day. Billions of dollars every single day. In transit, earning nothing yet by the person who had the transaction happen a day or 2 days ago. Now, the credit card companies are careful to describe themselves as technology companies, not as banks. They do not hold those funds directly on its own balance sheet in a way a bank would. This is very important, at least to them, because if they were considered a bank, they would have additional regulations that they would have to abide by. But as a technology company, just moving information, well, no bank regulations for them. They do not hold those funds directly on its own balance sheet in a way that a bank would. But it does require certain financial institutions to post cash collateral against the risk of that settlement exposure. That collateral, the billions of dollars, sits in accounts held in the credit card company's name in those settlement banks. And that money does earn investment income, but it shows up in their filings not as payment revenue, but in other ways such as non-operating income. A lot of times this translates out into credits that are given by the settlement banks to the credit card companies. So basically they are getting something that does have monetary value because it reduces the costs and the prices that they pay to these settlement banks. And it's easy to miss if you're not looking for it. But of course, most people don't even know what they would be looking for. The settlement banks that actually move the money holds the funds during the transfer window and earns on them through overnight markets. In exchange, that relationship produces credits and fee offsets that flow back through the system to the credit card companies in ways that don't show up as interest. That is the architecture of the float. It is intentional and it is structural. And both the card companies and all the banks involved benefit. But there's a funny thing about all this. The technology to move money instantly, in seconds, not in days, has existed for decades. The cost of processing a digital transaction has fallen so dramatically that what once cost dollars now costs fractions of a cent. The infrastructure is faster, and it's cheaper, and it's more capable than any other point in history. And yet, the float remains. The settlement windows remain. The fees have not gone down. Instead, they've actually gone up. That is not a technology problem, nor is it a problem about logistics. It's a choice. And understanding whose choice it was and how it got locked into law is something we're about to get into. Because the decisions that preserved the float and made sure it stayed profitable didn't just happen in the market. They happened in Congress, in the courts, and in the offices of federal regulators. But before we get to those things, we need to understand something that makes the float possible in the first place. Something that most people have never been told about regarding the money sitting in their bank accounts right now. Because that money isn't quite as yours as you think it is. And the reason settlement takes days isn't just about technology or logistics. It's about the fact that your bank has been using your money since the moment you deposited it. And getting it back so it can be sent somewhere else takes time. I would like to take a time out for a second. Before we get to the next section, I want to ask you to subscribe if you find this video useful and if you'd like to be notified when I release future videos. It helps me grow my audience and it helps us stay in touch. You don't have to do it now, but I do find it helpful to do something the moment you think about it instead of waiting and forgetting about it later. So I'll take a brief and awkward pause now and give you a few more seconds if you want to. It's okay. Money in the bank? You have money in the bank, or at least that's what you think. Here's what's actually true. The moment you deposit that money, the bank saw it as a loan from you to it. What you received in return was a promise that had a number on a screen, an IOU from the bank that says, in effect, we'll give it back when you ask. But the money itself, the bank put it to work the moment it arrived. This is one of the foundational operating principles of modern banking. It was originally called fractional reserve banking, since the bank would be required to hold a fraction of what was being deposited while being able to invest the rest. But now banks could technically use all of an account for investing, at least since the Federal Reserve's actions making the reserve requirement zero during the beginning of the 2020 coronavirus pandemic. And that policy is still being in place to this day. This means that your bank is not a vault like you think it is. It is lending your money to other people, investing it in financial markets, using it to fund its own operations. And it doesn't even have to keep a fraction on hand in case you and enough other customers want their money back at the same time. When you deposit money, you become an unsecured creditor of your bank. You have a claim against the bank for that amount, but the money itself, at least how the government and the banks view it, belongs to the bank. It's their asset, they say. Your cash becomes their asset to use as they please. Your account balance is simply the liability they carry on their books. It's a digital reminder of what they owe you. It's a little surprising when you think of it this way. Every time you've looked at your bank account and thought about the money sitting there, it hasn't been. It has been in circulation. It's been pooled and used to fund a stranger's car loan, or invested in an overnight market, or used to back a mortgage somewhere across the country. And this is where this connects directly to the pay-to-pay problem. When you make a payment, your bank doesn't just reach into a drawer and hand your money to the merchant's bank. Because they've already deployed their cash into those loans and investments, they have to settle their total daily position. They have to reconcile their internal books and move actual settled reserves through the interbank system to the other bank. That process, that daily unwinding of obligations, is part of why settlement takes the time it does. The float exists, in part because the money was never just sitting there, waiting to be sent in the first place. The bank has to make sure it has the liquidity to cover your move, while still keeping all those other loans active for their own profit. This is the original version of the problem. Before card networks or swipe fees, there was this simple fact. The moment you trusted a bank with your money, you entered into a relationship where that money was immediately deployed on the bank's behalf. And anytime you wanted to move that money, the bank had to be involved. And this is because it was the institution that stands between you and the thing you thought you owned. And that arrangement didn't happen by accident either. The full story of that, and about banks in America, this is also tied to currency and the Civil War, that'll be in a future episode. But now the important thing to get across is, once the law decided that banks could operate this way nationally, across state lines and beyond the reach of local rules, everything changed. The guardrails that individual states had built to protect their citizens from being exploited by that and other arrangements were stripped away, one court case at a time. And that is where this story takes its sharpest turn. The courts unleashed the cards. To understand how we got here, you have to go back to 1978. That's not when credit cards were invented. They'd been around for decades by then. But that year, 1978, is the year a single Supreme Court decision quietly reshaped the lives of ordinary Americans for all the years after. And most people have never heard of the case. It's called Marquette National Bank of Minneapolis versus First of Omaha Service Corporation. And what it did, in plain terms, plain meaning, was this. It told banks that the interest rate rules of the state where the bank was located were the only rules that mattered, regardless of where the customer lived. Before that decision, if you lived in a state that capped credit card interest at 12%, that cap protected you. It didn't matter where the bank issuing your card was headquartered. Your state's law applied to you. To understand what Marquette destroyed, you have to understand what usury laws were and why they existed in the first place. Usury is the charging of excessive interest on a loan, and it has been considered a moral and legal wrong for most of recorded human history. The ancient Greeks condemned it. Roman law restricted it. Medieval European law prohibited it outright, with the Catholic Church treating it as a sin equivalent to theft. The reasoning was simple and consistent across cultures and centuries. When a lender charges interest that the borrower cannot reasonably pay, the lender is not providing a service. The lender is extracting wealth from someone in a weaker position. The transaction is not a voluntary exchange between equals. American law inherited this tradition. From the colonial period onward, individual states established usury ceilings. These were maximum interest rates that lenders could legally charge, but they could charge no higher. Some states capped consumer lending at 8%, others later on in American history at 12%. But the principle was consistent. The state had the right and the obligation to protect its citizens from being charged interest rates that would make debt inescapable. The usury cap was not a regulation of commerce in the abstract sense, but rather it was a boundary on the power of a creditor over a debtor. It said that no matter how desperate you were, no matter how much leverage a lender had, there was a ceiling beyond which the extraction became legally impermissible. You just don't do it. That ceiling had survived centuries. It had survived the Industrial Revolution. It survived 2 world wars. It had survived the introduction of installment credit and charge accounts and the first generation of credit cards. The banks had worked within it. They complained about it. They lobbied against it. But for the first 2 decades of the credit card industry, the ceiling held. In 1978, the Supreme Court removed it with a single unanimous ruling. And they didn't do it by declaring usury laws unconstitutional or immoral or contrary to public policy. They did it as they often do, with semantics, with a change of a definition. Specifically, they redefined the word located. And the question of that word's definition came from a law passed in 1864 titled An Act to Provide a National Currency, secured by a pledge of United States bonds, and to provide for the circulation and redemption thereof. A little note about that title. Now, I've gone through hundreds of laws, read hundreds of pages of the statutes at large across, well, the 2 centuries of America. And I've taken note that the earlier laws that America passed were very descriptive in terms of what they were about. It's only been recently, and I guess maybe the later half of the 20th century, where they started actually making cute names for laws that have actually nothing to do with what the law actually does. But that's a whole nother story. That's probably going to be a different episode. But for now, that's a long title for a law, but that was pretty much the norm for most of America's history. Okay, staying focused. That law was an odd arrangement that created federal paper currency backed by bonds, which was basically debt. It was an emergency measure to deal with the shortage of gold and silver currency due to the high cost of the Civil War. It stipulated that loans could be charged interest at the rate set by the state in which the bank association was located. That is a whole story in and of itself that involves the changing of the law and its name by a later Congress, the Congress of 1874, that was viewed as one of the most corrupt of the 19th century. But I'll tell that story in a future episode. For now, covering what happened in the 1978 Supreme Court case, it's sufficient to say that the court ended a nearly 2-century history of strong state usury laws in a case that used a Civil War emergency law to do it. After that decision, it didn't matter where you lived at all. What mattered was where the bank was chartered, and banks immediately understood what that meant. If you could pick the state with the most permissive laws, or no laws at all, and set up your credit card operations there, then you could charge any rate you wanted to customers anywhere in the country. Your home state's rules were the only rules you had to abide by, and you got to choose your home state. And that race to the bottom, at least what I view it as, started almost immediately. Citibank made a direct approach to the state of South Dakota. They seemed to have made a deal. Citibank would bring jobs. South Dakota would eliminate its usury limits. South Dakota agreed. There was no meaningful debate. Citibank then moved its credit card operations there almost overnight. Other banks followed. Delaware did something similar. Other states competed for the business. And just like that, the patchwork of state laws that had protected consumers for generations was rendered basically meaningless. In a way, it was a competition for the lowest bidder. Every bank could now export the most aggressive rates in the country to every customer in every state, and they did. But 1978 was only the beginning. The court decision had freed banks to charge whatever interest rate they wanted. What it hadn't yet addressed was everything else. The late fees, the over-limit fees, the penalty charges that banks were increasingly piling on top of that interest. Those were still subject to challenge under state law. States like California were capping late fees at amounts as low as $5. But that changed as well, through a court case as well. A California woman named Barbara Smiley sued Citibank over late fees that were legal under South Dakota law, but would have been prohibited in her home state. The case made it to the Supreme Court, and while it was sitting there, waiting to be decided, the Office of the Comptroller of the Currency, that's the federal agency that regulates national banks, issued a new regulation. It redefined the word interest in the National Bank Act. By the way, that previous law that I mentioned from 1864, that was the original name, that long name. It was renamed the National Bank Act in 1874 by that corrupt Congress that I talked about. But again, that's a whole nother story. It gets complicated, but I'm trying to keep it simple here. Anyway, that executive branch agency defined the word interest, or redefined it rather, in the National Bank Act. And they said, with a magical memo, that this now includes late fees, over-limit fees, annual fees, and virtually every other charge a credit card company might want to impose. And this is the neat thing about the trick, because the timing was not a coincidence. By issuing that regulation while the case was already before the court, the agency ensured that the justices would feel bound to defer to it because of the court's own precedent. Under the legal doctrine in place at the time, courts felt obliged to defer to a federal agency's reasonable interpretation of an ambiguous statute. Of course, what is reasonable? What is ambiguous? The weapon was forged in 1984 in a case called Chevron. It basically told judges, if a law is vague, defer to the agency implementing the law. But I don't see what is vague about interest. I mean, interest doesn't mean fees, does it? Regardless, Justice Scalia wrote the unanimous opinion. The agency said fees are interest, and the court agreed. So if you look at the timing and actions, it's hard not to see that the executive branch teamed up with big business to force the court's hand to overrule a state's ability to limit fees against its citizens. And that's what's so tricky about these kind of things. Because when you're looking at laws and you're looking at regulations, you're looking at the courts, a lot of people look at one thing or the other. Political scientists will mainly look at the legislature, at the laws. Lawyers will look at what the judges are doing. But you got to see that it's an interplay. You got to see that a lot of times that the executive branch or the legislature, Congress, is actually looking at what the courts will do based on their previous decisions. So they're actually using an interplay of systems dynamics instead of using what they're doing directly. Anyway, fun stuff. So with one court decision, the $5 late fee that California had been trying to protect its citizens with became a legal fiction. So the fees you see in your statement today, whether you live in California or Louisiana or Arkansas, fees that exist in amounts that have nearly no relationship to any actual cost the bank incurred, they trace their legal foundation directly to that moment, that case in 1996, that was influenced by that executive branch agency's decision. So let's pause and consider what has been built. Banks could charge any interest rate they wanted because of 1978. They could charge any fee they wanted because of 1996. They had moved their operations to states that had been persuaded to strip their own consumer protections. And the federal regulators had been used not to protect consumers, but to lock in the industry's ability to extract from them. The 1990s, the decade of deregulation. So going back to that 1996 case, to understand why an agency of the federal government would intervene in an active Supreme Court case on behalf of the credit card industry, you have to understand the political environment in which it happened. The 1990s are usually told as a decade of pushing back against the Reagan-era financial deregulation of the 1980s. But that's not exactly what happened. Instead, the Clinton White House embraced financial deregulation as a governing philosophy. And this position was taken mainly as a strategic choice. The administration that signed Graham-Leach-Bliley, which repealed the Depression-era separation between commercial and investment banking. The administration that signed the Commodity Futures Modernization Act, which removed federal oversight from the financial derivatives market. This was the administration whose Treasury Department and OCC operated with the philosophy that market competition, and not consumer protection regulation, was the correct mechanism for governing the financial sector. This was triangulation applied to financial policy. Triangulation was a strategy pushed by Clinton advisor Dick Morris. This positioned Clinton between traditional Democratic and Republican positions. In practice, many of the policies the banks had been pursuing for decades came to fruition under a Democratic president, and with far less political resistance than they would have generated under a Republican one. The banks got a cleaner and more durable version of what they wanted from Clinton than they ever could have gotten under Reagan. And this is because Clinton's own party found it hard to oppose policies that their president championed. Think of it like Nixon goes to China, except it's Clinton going to the bank. The OCC action in the Smiley case was not an accident of bureaucratic timing. It was consistent with a governing philosophy that treated the expansion of financial industry capacity as an economic good and treated consumer protection regulation as an obstacle to that good. Understanding the mentality of the people who make these decisions is something I often seek out since it provides additional perspective. I do this as much as I can by reading what individuals involved actually wrote. In other words, the subject's own words without any filter. Bill Clinton's autobiography, My Life, is one of those books. It is detailed, candid in places you might not expect, and gives you access to the reasoning of someone who was at the center of these decisions in real time. I cover My Life and books like it on my other channel, Nonfiction Corner. That's where I go through the text and share my notes on what it reveals about the people and the decisions that shape the world that we're living in now. But what matters for this episode is the outcome. By the end of the 1990s, the legal architecture was in place. The interest rate ceiling was gone. The fee ceiling was gone. The regulatory apparatus had been enlisted in the service of the industry it was supposed to oversee. And as we'll talk about later, the check had been digitized and the float had been industrialized. But now we have to go back to the 1980s to look at something else. The story of how the federal government, the executive branch, pushed ordinary Americans into the credit card system, not by choice, but by mandate. Government mandates and the disappearing check. By the time the courts had finished their work, the credit card industry had the legal freedom to charge whatever it wanted. But legal freedom isn't the same as a captive market. For the system to reach its full potential, people had to be in it. And they had to be in it with no real alternative. Citicorp understood this faster than anyone. Walter Wriston, its chairman and chief executive, had spent years building the bank into something different from what banks had traditionally been. Not as a repository of capital, but as a processor of transactions. A technology company with a charter. Under his leadership, Citibank had introduced the ATM, pursued the credit card business with an aggression no other bank matched, and moved its entire card operations to South Dakota after that Marquette decision, With no usury ceiling in South Dakota, Citicorp could set its rates at will and export those rates to cardholders in every state in the country. By 1981, Citicorp had acquired Diners Club, the card that people think about as the original credit card. The bank now held a card brand, a South Dakota charter, and a business model built on the premise that the only limit on what you could charge someone was what they would accept. And that's where the government came in. In September 1982, Congress passed the Federal Managers Financial Integrity Act. You could find this law in the statutes at large. And I want to pause for a moment to talk about the statutes at large. The statutes at large are the actual laws passed by Congress. Now, you'll hear something about the U.S. Code, United States Code. It is a compilation and an organization of the law. But if you want to actually look at the actual law passed by Congress, you have to go to the statutes at large. Within the statutes at large, it's on 96 Statute 814. In the way you read a statute of large citation, the first number is usually the volume number, so volume 96. The last number is the page number, 814. So in this instance, 96 Stat 814 is volume 96 of the statutes at large, page 814. One thing I want people to start getting used to is looking things up yourself, because we've become so reliant, whether it is some talking head on television or some expert that's reading. Sure, they might have expertise, but it's always good to trust, but verify. And the only way to verify is to check for yourself. So anyway, that law required the head of every executive agency to certify annually that the agency's internal accounting and administrative controls were adequate. If they weren't, the agency head had to report every material weakness in writing to the President and to Congress, and had to do it publicly. The OMB, the Office of Management and Budget, was required to issue evaluation guidelines by the end of that year, and agencies faced their first mandatory compliance deadline in December of 1983. From everything that I could tell, the law was written in good faith, with an effort to actually try to create more efficiency in government. The law was written by Jack Brooks, a Texas Democrat who chaired the House Government Operations Committee and has spent 3 decades as one of Congress's most effective watchdogs over federal waste. He wanted agencies to account for where the money went. He did not design what came next, however. The law provided the hammer, but the OMB provided the target. By defining cash advances as a material weakness in its 1982 and 1983 guidelines, the administration turned a bipartisan watchdog's law into a mandate for private sector banking. What came next was controlled by the executive branch. David Stockman ran the Office of Management and Budget. His deputy, the man responsible for day-to-day operations and the administration's 6-year modernization initiative, which was called Reform 88, was Joseph Wright. Joseph Wright had come directly from running Citicorp's credit card divisions. Wright oversaw Citicorp Retail Services, and Citicorp Retail Consumer Services, and Citicorp's consumer card subsidiaries. At the same time, Citicorp's chairman, Walter Wriston, was serving as chairman of Reagan's Economic Policy Advisory Board. He held that position from 1982 to 1989. The most powerful commercial banker in the country, the man who had personally engineered the South Dakota move, held a formal advisory seat at the president's table throughout. The compliance framework that Stockman's OMB built under that law that Congress passed in 1982 created a specific problem for agencies. Cash-based travel advances, which was the money handed to employees before a trip, were tracked by paper ledger. And these were exactly the kind of systems that couldn't produce the reliable, auditable records the law now required, or at least how the OMB interpreted the law to require. The GAO's first government-wide review of that law implementation was published in 1984, and it reemphasized that cash management was among the most frequently reported material weakness categories across federal agencies. Agencies couldn't show reasonable assurance over their travel advances. The compliance pressure needed a solution. In 1983, the General Services Administration opened competitive bidding for a federal travel card contractor. The contract went to, not surprisingly, Citicorp, and its subsidiary, Citicorp Diners Club. The rationale, they said, was explicit. A commercial card eliminated the cash advance, shifted the float to a private bank, and gave auditors a digital record of every transaction. The material weakness was remediated. The annual report to Congress would be clean. The bank that won the contract was the same institution that had moved to South Dakota specifically to escape the consumer protection laws that every other state still nominally maintained. The bank that broke the usury cap system became the bank the federal government contracted with to handle its employees' travel. The Supreme Court supposedly made it legal for Citicorp to charge whatever it wanted. The OMB that operationalized the compliance framework was run by a man whose deputy had previously run Citicorp's credit card subsidiaries. The president's chief economic advisor was Citicorp's chairman, and the GSA signed the contract. What that arrangement shifted was payment responsibility. Under the new structure, employees using the card were responsible for charges incurred during official travel, with reimbursement to follow from the government. The timing mismatch between expense and reimbursement, a gap the government was not always fast to close, fell on the employee, not the Treasury. The bank's revenue in this early phase came primarily through merchant fees, not interest. That arrangement would deepen significantly over the following decades, as individually billed accounts became standard, and as personal liability for government travel charges became explicit policy. In 1984, GSA formally introduced charge cards across the government. In 1986, the administration piloted a purchase card program across 24 federal agencies. By 1989, it had a government-wide contract. By 1994, a second contract. A growing share of federal procurement, especially small purchases, was now running through commercial card networks, through Visa and MasterCard infrastructure, generating billions in transaction volume and interchange fees for the bank industry every year, and now doing so with your taxpayer dollars. And in 1996, the Debt Collection Improvement Act required most federal payments to move toward electronic funds transfer. Salaries, Social Security, veterans benefits, money that had often arrived by paper check was increasingly routed through the banking system instead. But the government wasn't done. In 1998, Congress passed the Travel and Transportation Reform Act, which made use of the government travel charge card mandatory for most official federal travel. By statute, federal travelers were increasingly required to use commercial bank card products to do their jobs. What had once been cash, checks, and internal government payment methods was being rerouted piece by piece through private financial infrastructure. And then came 2003. Check 21. The check clearing for the 21st Century Act, Check 21. The official story is that it was an emergency response to September 11th, when the FAA grounded all flights. The Federal Reserve Bank's daily check float, normally a few $100 million, ballooned to more than $47 billion in a single week. The banking system's dependence on air transportation had been exposed as a single point of failure, and Congress responded. But that's not the full story, because the Federal Reserve and the banking system had been working on the underlying framework for nearly 2 years before the towers fell. The push for check truncation, as it was called, the legal right to digitize and destroy the paper, had been building since the late 1980s. That's when banks began developing electronic check imaging technology and running into a wall. No bank could be forced to accept a digital image in place of the original check. Eliminating that wall required legislation. The law passed both chambers in 2003. What it authorized had 3 distinct effects that the efficiency narrative didn't advertise. The first was the destruction of the evidentiary record. The law allowed banks to scan a check, transmit the digital image, and legally destroy the original paper. No retention requirement was added. In many cases, the original check was gone. What disappeared with it were the physical security features. Those were the watermarks, the paper texture, the ink depth. That's what made forensic verification of an original document possible. The Federal Reserve's own analysts flagged this, because once originals were destroyed, traditional security features would no longer be available to verify authenticity against sophisticated forgery. The second was the creation of a new private toll system. The efficiency gains from eliminating planes and armored trucks did not flow into a public utility. A new layer of private infrastructure arose to move digital images between institutions that couldn't exchange them directly. Private intermediaries and clearinghouses stepped into the role. And of course, they didn't do this for free. The Federal Reserve itself began charging per transaction fees for its Check 21 image products. The Electronic Check Clearinghouse Organization, ECHO, which had been instrumental in developing the legislation, became the governance body for private image exchange. By 2018, ECHO was acquired by the Clearinghouse, a private entity owned by the largest commercial banks. The public movement of money now ran through a private toll system owned by the institutions whose costs it was supposed to reduce, but instead reaped the rewards of it. The third was the inversion of the float. Before Check 21, when you wrote a check, the time it took paper to travel was a buffer. The debit had not yet hit your account. After Check 21 allowed electronic presentment, that buffer disappeared. Banks described the advantage in their own words. One official told the GAO that electronic capture gave the institution better float management. Better float management for the bank meant, well, less float for the consumer. The rules governing incoming deposits, the other side of the ledger, had not changed. They were set by the Expedited Funds Availability Act of 1987 and remained governed by that statute. This meant that 3-day period within that 1987 law continued to remain, even though the money could move faster. Before I continue, I would like to mention that I will be using email to send out updates on issues I cover in my videos. I'll be using this as a way to expound on some of the issues and also add more perspectives, as well as updates that happened from when I originally posted the videos. For instance, currently I'm working on updates on the Postal Service debt issue that was mostly created by Congress. And I know I'll have some follow-ups on this important issue of us paying just to simply use our money. So if you are interested in getting email updates on these types of things, send me a message at jeremy@plainmeaning.com. I'll pause for a moment if you need time to write the email down. Okay, time to get back to it. So the paper check was mostly gone. The float had changed hands. The intermediaries were collecting fees. The technology had made it faster to take your money, but it had not made it faster for you to use it. The float didn't disappear, it was redistributed. The cost of processing a digital transaction had been falling for decades. What cost dollars in the 1970s costs fractions of a cent today. And yet the fees charged to move money through these systems didn't fall with the costs. Between 2014 and 2024, fees paid by U.S. merchants on Visa and MasterCard credit cards nearly tripled, rising from about $39 billion to over $100 billion a year. The efficiency gains went to the industry. The costs stayed with you. That's not a market outcome. That is what happens when the legal and regulatory architecture is built to protect the toll collectors rather than the people paying the toll. Every law and regulatory move we covered, the OMB directive, the GSA contracts, the prompt payment amendments, the Travel Reform Act, the EFT mandate, Check 21, each one of those moved more people onto the system, made the alternatives harder to use, and made exit almost impossible. By 2004, you couldn't get paid without a bank, for the most part. You couldn't work for the federal government without a commercial card for travel. Your checks were being destroyed the moment they were scanned, and the float was transferred to the middlemen, which were making money off of it. But while all this was happening in the United States, something very different was happening elsewhere. Two countries, one in South America and one in Eastern Europe, looked at the same problem and decided to solve it in an entirely different way. Pix and Blick. In November 2020, Brazil turned on a switch. It wasn't a product launch, nor was it a new app from a technology company. It was the Central Bank of Brazil, the government itself, flipping on a piece of public infrastructure that it had built, that it owned, and mandated that every major financial institution in the country participate in. And they called it Pix. Within 4 years, it had become the most used payment method in Brazil. More used than cash. It was more used than credit cards and more used than debit cards. In fact, more used than any other legacy system that had come before it. And here's how it works. Every person and every business has a Pix key. It's a simple identifier tied to their account. This identifier can be a phone number, an email address, a tax ID, or a randomly generated code. When you want to pay someone, you use their key. The money moves from your account to theirs in under 2 seconds. It works 24 hours a day, 7 days a week, every day of the year, including holidays. There is no batch processing. There is no clearing window. There is no settlement delay. The money moves when you send it, and that's it. For individuals, Pix is free. Let me say that again. For individuals, Pix is free. There are no transaction fees for personal payments. For businesses and merchants, the fee is less than 1%. Now compare that to 2.5% average that credit cards charge in Brazil, and of course the much higher average that we get charged in the United States. Merchants who accept Pix often pass those savings directly to customers in the form of discounts. In 2024, Brazilians completed roughly 68 billion Pix transactions, worth approximately $5 trillion. That was a 52% increase from the year before. Pix now accounts for 47% of all financial transactions in Brazil. 93% of Brazilian adults use it. A government-built public utility replaced a private toll system in 4 years. The argument that moving money instantly is technologically impossible is simply not true. Brazil did it. Poland arrived at a similar destination, but by a different road. In 2013, 6 of Poland's largest competing banks sat down together and made a decision. They recognized that if they didn't build something better themselves, the American card networks would continue to dominate their market and extract fees from Polish commerce indefinitely. So they formed a company called Polski Standard Płatności. My Polish pronunciation is terrible, but it meant the Polish payment standard. And it built a shared mobile payment system from the ground up. They called it Blick. Blick works differently from Pix. Instead of a permanent key, it generates a 6-digit code directly inside your banking app. The code is valid for 2 minutes. You enter it at the register or on the checkout page of a website, and then confirm the payment in your app. The money moves instantly. The code expires. There's no card number. There's no static credentials that can be stolen. No multi-day settlement gap. You can also use Blick to withdraw cash from an ATM without a card. By 2024, Blick users completed 2.4 billion transactions. It had become one of the largest mobile payment systems in Europe, and it's expanding into Slovakia and into Romania and other parts of Central and Eastern Europe. So 2 countries, 2 different approaches. One did it through government mandate and the other through industry cooperation. Both arrived at the same fundamental conclusion. The technology exists to move money instantly. The fees charged by legacy card systems are not justified by actual costs, and ordinary people and small businesses deserve a payment system that works for them. In Brazil, the card companies fought it. They lobbied against Pix. They tried to protect their market share, but they failed because the central bank had the authority and the will to simply require something better. In Poland, the banks built it themselves because they understood that if they didn't, someone else would, and the fees would leave Poland entirely. In both cases, the system that exists in the United States, the one we've spent this entire episode describing, was looked at, evaluated, and rejected as simply too expensive and too slow. This brings us to an obvious question. If Brazil could do it, and Poland could do it, if the costs have fallen to almost nothing to move money digitally, and if other countries looked at the American payment system and decided their citizens deserve better, why are we stuck with fees while the credit card companies and banks profit for slowly moving our money? But didn't you choose it? The standard defense of the fee system is that it's the price of a service, the price of credit. The bank extended you an interest-free loan for up to 30 days. The merchant covered the cost of that arrangement, and nobody forced you to do it. You chose to borrow. You chose the card. Except that argument only works if you actually had a choice. And for most of the history of the modern payment system, you didn't. For decades, if you wanted to make an instant in-person payment without carrying cash, a credit card was not one option among many. It was the only one. Checks required trust and days to clear. Wire transfers required a bank visit and fees that dwarf most transactions. The infrastructure for instant digital payment at the consumer level simply didn't exist. Not because the technology was impossible, but because, as we've already covered, the decisions made in the 1970s ensured it would not be built as public infrastructure, that it would not be available to everyone. So the choice was never credit card or something equally fast and convenient. The choice was credit card or cash. And cash, as the government's own mandates made increasingly clear, was something that was being more and more discouraged. But here's where it gets interesting, because even after people understood that credit card fees were being baked into the price of everything they bought, someone asked the obvious question. What if we just don't use credit? What if we pay with our own money, directly from our own account? The answer the system gave back was, you still pay. When debit cards became widespread in the 1990s, they seemed like a genuine escape hatch. There was no credit, no borrowed money, no interest, just your own funds leaving your own account at the moment of purchase. So the whole justification for that idea that the bank was extending you credit, that the merchant was benefiting from the bank's willingness to take on the risk, collapses entirely when there's no credit involved. But the fee didn't collapse with it. Debit interchange fees are lower than credit card interchange fees, but they're not zero. The Federal Reserve's own data show that for large bank debit cards subject to the cap, interchange averages roughly 22 to 24 cents per transaction. Debit is cheaper, but your own money at the register still carries a toll. And that toll, like the credit card toll, finds its way into the price of the goods. Congress looked at this and tried to do something about it. The Durbin Amendment, part of the Dodd-Frank Act in 2010, capped debit interchange fees for large banks. Senator Dick Durbin's argument was direct. Consumers ultimately pay for all of these fees in the price of goods and services they buy. That's true. So the idea was lower the fee merchants pay and they'll lower the prices. The savings would flow through to the people doing the shopping. With more than a decade of evidence, that transfer never really happened. A Richmond Fed survey of merchants found that 75% reported no price change after the rule took effect. 23% actually raised prices. 2% lowered them. The merchants who were supposed to pass the savings along mostly didn't. But I think I know why. Because around the same time period, you saw an increase in credit card use versus debit cards. And this seems to be a pattern. You decrease the fees in one area, then they'll just raise the fees in another area. So that gets us to the other side of the ledger. Banks don't absorb losses, or more specifically, they don't absorb losses to their profits. They move them. When the Durbin Amendment cut the interchange revenue flowing to large banks, those banks responded by eliminating the products that had been cross-subsidizing with that revenue. GAO found that at large banks covered by the regulation, the share offering free checking accounts fell from 60% to less than 20%. Checking fees rose. Minimum balance requirements tightened. Accounts that had been free became accounts with monthly maintenance charges. So you actually get the worst of both worlds. You have the increase in the use and availability of credit cards, and the increase in the cost of using checks. Much of the cost didn't disappear, it was shifted elsewhere in the system, from the merchant's processing bill to the consumer's monthly statement. Congress regulated one extraction point, and the architecture just found a different way. This is what happens when you try to reduce the cost of a system whose participants have no incentive to reduce their own revenue. They simply relocate where they can collect it. So if both credit cards and debit cards carry fees, what about going one step further? Why not load your own cash onto a card in advance? No bank account, no credit, no debit, just money you already earned, put into a card you control, which you can spend anywhere cards are accepted. Nope, you still pay. Prepaid cards may carry activation fees when you purchase the card. Monthly maintenance fees are deducted automatically from your balance whether you use the card or not. Per transaction fees are charged every time you make a purchase. And then there's ATM withdrawal fees, cash reload fees charged every time you add money to the card, balance inquiry fees, customer service fees, and then if you don't use it, inactivity fees if you don't use the card for a certain period. And there's something tragic about this, mainly because of the people that are using these prepaid cards with all these different fees. Prepaid cards are used disproportionately by people without traditional bank accounts, people locked out of checking accounts by overdraft history, or by minimum balance requirements they can't meet. FDIC surveys consistently find that unbanked and underbanked households, those most likely to depend on prepaid cards, are usually the poor. These are among households earning under $15,000 a year. So the people with the fewest options pay the most to participate. And it's something most people really don't talk about. The origin of the fee. There is one more thing worth understanding about how the interchange fee came to exist in the first place. This is because the industry's own explanation has always had a gap in it. The official story is that interchange compensates the card issuing bank for its costs. These costs are fraud prevention, credit risk, network infrastructure, and the rewards programs that keep consumers using cards. But that's not the full explanation. Testimony in Congress has brought up the fact that these interchange fees were developed in part as a way around state usury limits. Because the fee is charged to the merchant, it occupied supposedly a different legal lane from the traditional caps that states had spent generations building. It was basically a parallel revenue stream that, at least in part, sat outside those constraints because it was collected from merchants rather than directly from borrowers as interest. This connects directly to the history we've already covered. The banks spent the late 1970s and 1980s systematically dismantling the interest rate ceilings that constrained what they could charge consumers. But when the cap was removed, they continued with those merchant fees as well as the interest that was steadily rising on those credit cards to the consumers. You were never just paying for the cost of credit. You were paying for the infrastructure, for the float, and for a fee that was built to occupy a corner of the financial system that the laws designed to protect you weren't looking at. This was whether you used credit, debit, or cash you loaded onto a card yourself. The card in your wallet, whatever kind it is, runs on rails built to collect a toll on every transaction. The toll varies by card type, but the destination is the same, and the profits definitely don't go to you. The road not taken. In 1974, Congress did something unusual. It looked at a technology still in its infancy and decided to study it before it became permanent. What it was looking at was the electronic movement of money. The National Commission on Electronic Fund Transfers was established that October of 1974, and it was tasked with answering a question that sounds simple, but turned out to be one of the most consequential policy decisions that impact almost every American today. Who should own the infrastructure that moves money in America? At this point, the answer wasn't predetermined. The question was fought over. It was debated and ultimately decided in a way that most Americans never knew about. Fernand St. Germain of Rhode Island, a Democrat who had spent his career on the House Banking Committee, was a key congressional backer of the commission. But the bill had a problem baked into it from the start. It was bundled with an increase in FDIC deposit insurance. This was obviously a banking-friendly measure, and its enabling mandate contained a clause that required the commission to consider assuring government regulation and involvement or participation in a system competitive with the private sector be kept to a minimum. Basically, don't compete with the companies. That basically kept the commission constrained with an almost inevitable outcome. And the Commission's membership made the outcome even more likely still. The enabling statute specified that 7 of the presidential appointees were to be officers, employees of, or representatives of banking, thrift, or other business entities. On top of that, the chairman of the FDIC and the FCC and 2 state banking regulators were built in as automatic members. It was simply a study commission, but that commission had a lot of members on it that had incentives to see the study go a certain way. So what is remarkable is not that the commission reached the conclusions that it reached. What is remarkable is what it had to walk past to get there. In the 2 years the commission was working, it received an enormous volume of public mail. Wayne Boucher of the National Commission on Electronic Fund Transfers told a gathering of data processing auditors, in remarks later reported in Datamation, that during one 2-week period, the Commission received 6,000 letters about the future of electronic money. Of those 6,000, 11 were in favor. 10 were uncertain. The rest, as Boucher put it, were desperately and utterly opposed. People were worried about unemployment. They were worried about teller jobs disappearing into machines. They were also worried about the loss of the paper check, and which gave them a degree of control over their own money they could see and touch. They worried about surveillance, about increased costs, about errors and theft. And some of them, enough to surprise even the Commission, cited the book of Revelation, basically equating the use of electronic money as some sort of mark of the beast. To put it in context, the Universal Product Code, the barcode, had just been standardized just the year before and was beginning to appear on grocery store shelves. Hal Lindsey's The Late Great Planet Earth had already sold millions of copies, priming readers to look for exactly these signs. A checkless, cashless society where you could not buy or sell without a digital mark was not, for these letter writers, a policy concern. It was a prophecy being fulfilled. But you could read those letters 2 ways. One reading is that these were the fears of people who did not understand the technology. The other reading is that they understood something essential about what was being built, that a system where every transaction leaves a permanent, searchable, monetizable record is a surveillance system, whatever else it might be called. 50 years later, that second reading looks kind of prescient. EFT in the United States, Policy Recommendations and the Public Interest, was released in October of 1977. It took those discussions among the commissioners and those 6,000 letters and translated them. It did not say the public was terrified and therefore the transition should be slowed or the infrastructure should be publicly owned. It said there was a public education problem. The fears were real, but they were the product of misunderstanding, and the solution was better disclosure and clearer consumer rights, not a different structural answer. This translation from a moral and democratic question about who owns the payment system to a technical question about consumer notification requirements, this is the central act of the Commission's work. And it did not happen by accident. The debate over who should build and own the infrastructure had already been conducted, in public, by men who knew exactly what was at stake. What the Commission ultimately produced was a set of recommendations that gave the public just enough to make the system legally acceptable. A receipt, a right to dispute errors within 60 days, and liability limits on stolen cards. But it didn't really address the underlying question of who owned the rails and what they could charge to use them. The Commission saw the privacy problem clearly, devoting 19 specific recommendations to it, and watched as only a fraction made it into law. The 2 statutes that emerged, the Electronics Fund Transfer Act of 1978 and the Right to Financial Privacy Act of 1978, both part of the legislative response to the issues the Commission studied, illustrate how completely the original question had been reframed. The Electronic Fund Transfer Act gave consumers procedural rights, things like notice, error resolution, and limited liability. The Right to Financial Privacy Act is the more instructive of the 2. It was Congress's direct response to United States v. Miller, which was a 1976 Supreme Court decision that had dealt a severe blow to financial privacy by holding that bank records don't carry Fourth Amendment protections at all. And their reasoning? Because you voluntarily shared your financial information with your bank. Therefore, you didn't have reasonable expectation of privacy. The government could get those records without a warrant. The 1978 Act created procedural requirements around that access. The government had to follow specific steps, use an administrative subpoena or formal written request, and in most cases notify the customer. But it lowered the standard. It actually ended up validating what the court was saying, that the government doesn't need a judicial warrant to get your records. And it actually goes against another court case that I cover in depth in another episode that's about banks being agents of the government. But regardless of what the court said and what Congress said, the Fourth Amendment stands. But getting back to our story here, the important part to understand is, by the end of the 1970s, You now had financial transactions being treated as something that weren't yours, but instead something freely available to whether it was the government or corporations. Those 6,000 letter writers back in the 1970s, they saw it. The commission acknowledged it, but yet Congress ended up doing something different anyway. The new toll collectors. The story of electronic payments was supposed to have a second chapter. After the card networks and the banks came the technology companies. These were companies like PayPal, Venmo, Square, and Stripe. And their promise was familiar. They would create something faster, simpler, and cheaper. And in some ways, it was. You could split a dinner bill in 30 seconds. A small business could accept payments without a merchant account. A freelancer could get paid from across the country without a wire transfer. But what was less visible, however, was what these companies were actually doing and what they were actually building in the background while you were tapping your phone. PayPal, Stripe, Square, and Venmo are payment aggregators. This is a technical term that describes a specific structure. Rather than giving each merchant its own account with the underlying banking system, the aggregator holds a single master merchant account and processes everyone's transactions underneath it. Everyone is treated basically as sub-merchants. In other words, you don't own the transactions. When a merchant or person processes payments through an aggregator, the money does not go directly to the merchant's bank account or your bank account. It goes to the aggregator's master account first. The aggregator then decides when to release it. In practice, this can take anywhere from one business day to a week, depending on the platform and the merchant's volume and risk profile. Aggregators also claim that they have the right to freeze or terminate accounts, and they do this often without warning, often without any explanation and with limited meaningful appeal. You're not operating your own account. You're simply a tenant renting a portion within their store. The float, which is the practice of earning interest on money that belongs to someone else while it sits in transit, that didn't disappear with this. It just changed addresses. PayPal in 2024 processed $1.7 trillion in payment volume. Even a fraction of a percent earned on money held in transit at that scale produces significant income. But the float is not where the real transformation happened. The real transformation happened when these companies realized that the data flowing through their systems was more valuable than the transactions themselves. In January 2024, PayPal announced what it called its Advanced Offers platform. This was a new advertising business built on the transaction data generated by its nearly 400 million active accounts. PayPal uses the data it gets from you and others to sell targeted advertising to brands who want to reach customers based on what they have actually purchased, not just what they have browsed. But what it represents is a company that was paid to move your money, now also being paid by advertisers for information about how you spend that money. The transaction that was supposed to simply transfer value from your account to a merchant's is also generating a product that PayPal and others sell to third parties. And that product is based on your records, your personal and business transaction records that are on its platform. But it's not just the aggregators. MasterCard sells aggregated and anonymized bundles of cardholder transactions data to third parties through its in-house data and service division. The legal framework governing all of this is the Gramm-Leach-Bliley Act of 1999. That's the same law that repealed the Depression-era separation between commercial and investment banking. On privacy, the law's real effect was to ratify the abandonment of financial privacy by an industry that once prided itself on discretion. Under Gramm-Leach-Bliley, companies can share customer financial data with affiliates and joint marketing partners without giving consumers a meaningful opt-out. And the categories of who qualifies as a joint marketing partner are broad enough to encompass almost anybody. And it gets worse. When you link a bank account to a third-party application, whether it's a budgeting tool or a payment app or even an investment platform, you often go through a financial data aggregator like Plaid or Yodlee. These companies act as the plumbing between your bank and whatever application you're using. For years, they operated primarily through credential sharing. You gave the aggregator your bank username and password, and the aggregator logged into your bank as you, scraping whatever data it needed. This practice is called screen scraping. When you share your credentials with the aggregator, most major banks' terms of service specify that you have authorized a third-party agent to access your account, and that if something goes wrong, the bank's liability protections may not apply to you. The architecture that the public feared in the 1970s, a central system that knew everything about your spending, that could be used to profile and target you, that turned financial transactions into a form of surveillance, it exists. It was not built by the government, though. It was built by the private companies that were entrusted with the infrastructure instead. The government just created the legal and policy environment that made it possible. The difference between the feared government data bank and the actual private one is not privacy. It is accountability. The government data bank, had it been built, would have been subject to government restraint, to Freedom of Information Act requests, to congressional oversight. The private data banks that replaced it are subject to terms of service that you click through without reading, to privacy policies that disclose categories rather than specifics, and to a legal framework that was written by the people it was supposed to regulate. But beyond that, it would have added a choice. Now, unless you use cash or write a check, the only real choices are the ones, for the most part, offered by payment aggregators and credit card companies. Only for a few. The payment systems defenders have always had one reliable argument. It's complicated. Moving money between two people sounds simple, but the infrastructure required to do it reliably and securely, well, it's not that simple. The settlement delays, the interchange fees, those layered intermediaries, all this is complicated, and we need those complications because, well, safety, for security, to make sure the money flows properly. But as we already noted, Brazil and Poland didn't find it all that complicated, and they built something for everybody. America, it seems, built something too, but you've probably never heard of it, and that's because it's not for everybody. In July 2023, the Federal Reserve launched FedNow. FedNow is an instant payment infrastructure that processes transactions in approximately 20 seconds. It does this around the clock, every day of the year. It costs the Federal Reserve $545 million to build. It charges participating financial institutions 4.3 cents per transaction. That's less than a nickel to move any amount of money instantly through the banking system. But here's the surprising thing. After investing that much money in building this thing that works, and that works so cheaply with each transaction, the Federal Reserve decided that consumers couldn't use it, at least not directly. There is no FedNow consumer app. The Federal Reserve does not provide payment services directly to consumers and businesses. Individuals access instant payments only through participating banks or credit unions. As the Federal Reserve's own fact puts it, bank and credit union customers will probably not even see the name FedNow on their bank's instant payments platform, as the FedNow service is the high-speed highway that helps payments move from one financial institution to another. Banks and credit unions build new products for their customers that connect to the highway. So, as for what fees those institutions might charge consumers for services built on top of that highway, a Federal Reserve spokesman told PolitiFact that the Fed could not speak to that. The government built a 4-cent highway and handed the keys to the same institutions that had been charging for the slower road. Those institutions are under no obligation to pass the savings to consumers. Participation in FedNow is voluntary. The United States made adoption optional, which means the institutions with the most to lose from cheap instant payments had the least incentive to adopt it aggressively, or adopt it at all. This is the pattern that is repeated at every stage of this story. The government builds infrastructure, the ACH networks in the 1970s, electronic payment mandate for federal disbursements in the 1990s, FedNow in 2023, and then designs the access rules so that the benefit flows to institutions rather than to the people the infrastructure was supposed to serve. The consumer pays a private toll to use a public road. In 1977, 6,000 Americans wrote letters to a federal commission expressing a fear that turned out to be, well, correct in some ways. They were afraid of a system that would know everything about their spending, that they could not escape, and that would extract from them without their full understanding of how. That commission heard those letters, translated their fears into consumer disclosure requirements, and handed the infrastructure to the private sector. By 2026, the private sector had built exactly what those letter writers feared. It had just done so with better branding. The checklist society arrived. It came with a social feed, an advertising platform. The float still runs, and the fees still compound. And your personal and business information is now a product. And so that's the story, in a nutshell, of how we're now paying just to pay. As for me, I think I'm sticking with cash.